So let's get a sense of where we're going in the new month and the final quarter of the year. Let's talk to Wale Ulusi, who is the head of research at United Capital. United Capital is an investment bank listed on the stock exchange where Wale Ulusi is seated talking to us this morning. Good morning. Good to have you on the show, Wale.
Good morning, boss. It's a pleasure.
Thank you.
To be
nice
here.
to have you. The big story for the banks is this 60% loan-to-deposit ratio deadline today. But again, if you look at between June, July, and August, it was almost on a weekly basis that the central bank is hitting the market straight, in particular the banks, the banking sector, with one policy, one circular or the other. So that all takes us down to today, which is the deadline for the big one as far as the loan-deposit ratio is concerned. The central bank chief, Godwin Emefiele, told Bloomberg last week that feedback so far shows excellent compliance for all commercial banks with the new LDR threshold. What's your take?
Well, I mean, the feedback and the feelers we are also getting from the market is also suggesting that it looks like most of the banks have been able to find their way around the recent LDR ratio pronouncement by the central bank. However, the area we are not so comfortable or we are not so sure about is many of the international banks, most of whom don't play in the retail space. We don't know if there's going to be any, I don't know how the CBN wants to treat them, the likes of Citi and many of these international banks. We are not sure if they will be able to play the way the local banks have been able to play the game. But generally, based on the feelers we are getting from the market, we think most of them will not want to take another hit from the central bank. I think by now they will have sorted themselves out.
Technically, do you think the central bank will be comfortable, as it were, if all the tier 1 banks meet this 60% loan-to-deposit ratio threshold, and perhaps a few of tier 2 banks, and perhaps we'll let everyone go, as it were? But that interview with Bloomberg says there will be sanctions for banks that fail to. Any idea what these sanctions could be?
Well, I mean, in the pronouncement initially, they've already stated what the sanction will be. The central bank is going to take extra regulatory reserve from, any of the banks that will not meet up with, this requirement. So if the CRR is currently 22.5%, what that means is that the central bank will be taking an additional liquidity out of any bank that is, not meeting up with the new pronouncement as a penalty.
But the earlier part of my question was, do you think the central bank will be comfortable if the tier 1 and perhaps a few of the tier 2 meet the deadline today and perhaps give an extension, as it were, to other banks who are in tier 2 and perhaps tier 3, I'm sure?
Well, I mean, the way we see it, we don't see any concern as far as the tier 2 banks are concerned. Most of them, they don't have as much liquidity as the tier 1 banks. So I don't even see any, any of them not meeting up, because as at Q2, most of them are already above the minimum ratio. The tier 1 banks, however, are, the areas where we want to look at, critically. I doubt if the CBN will want to give any extension, but I think most of the tier 2 banks, by now, because based on their Q2 number, they are pushing, very closely to that level. By now, many of them will have found a way either to cut deposit or to aggressively increase their loans just to meet up. Like I said, it's more of the international banks that don't play in the retail space that, the touchlight should probably be on as at today.
Okay, let's look at the Q4, your outlook on the Q3, 9 months that will be coming through in Q4. And do you think that will mirror what to expect in the final quarter of the year for the banks?
Well, I mean, Q3, our expectation, based on what we saw in Q2, is that you will see a slight uptick in risk asset growth That's loan because of this LDR ratio. Unlike in the first half of the year where, loan growth remained very, very tepid. Non-interest income was driving, most of the growth we see for revenue, which was generally, very slow. So in Q4, we think most of the banks will continue along this line. Don't forget, there are new pronouncements that also comes in during the third quarter of the year to also enhance the security or the safety of loans of the bank. And that's the one that granted, banks the access to third-party account. If customer A is owing Bank A can approach Bank B, where customer A also, has some assets, and you can recover your debt if the customer is defaulting. I think these are issues that will, boost credits to the real sector and many of the banks. And don't forget, NPLs have been coming down. The committee member in MPC expressed satisfaction at the level of, improvement in the overall financial system. So we think we'll continue to see slight improvement in the banking sector. But as far as, sharp interest income growth is concerned, that might not happen because I don't think they want to aggressively, increase assets. Most of the risk assets going out is to retail space, and it constitutes a small proportion of the overall risk assets of the banks.
Your investment bank you work in a banking environment, which is the UBA group, so the investment bank. So what are you learning? What are you seeing? What are you hearing on the ground as to this drive for a credit expansion in the real space by SMEs and all that by the central bank? Is it really coming through?
Well, yeah, it is actually coming through. What we've been hearing is many of the tier one banks, most of them around us here in Marina, driving aggressively their USSD credits platform. Some of them are using their mobile platform to do that. And we've seen increased aggressive adverts on radio, via email marketing as well, to increase the size of credit that goes. So I think many of them are pushing it. They are trying to meet up. At the same time, they're also looking at what the fintechs are getting out of this. Apparently, the rate of non-performing loan among the retail space is actually considerably low compared to what you would expect, because you'll have profiled these customers, you'll have seen their transaction history, and apparently the banks are trying to jump in as well. There are different interest rates trying to track what is happening there. Many of them are giving out credits for 1 month at about 2% or something lower or higher. And it looks like people are taking it. Payday loan is a thing now in the market. If I'm coming to work in the morning, there's a host of sales agents, close to the entrance, trying to convince me to come take at least 5 million. So I think people are driving it aggressively.
Interestingly. And those folks I'm not sure they know you work in a bank, a banking environment, big building up there, Marina, offering you 5 million. 5 million is a token for you.
I think they see how I dress. I think I can take it.
No, they're not. I'm not sure they saw the crest there.
They see how I dress it.
Offering you 5 million naira. Let me offer you 5 billion. That's a whole lot more money. I'm sure you could fall for 5 billion, not 5 million naira, by the way. UBA is far a lot more. UBA will give you 5 billion, not 5 million naira, I'm sure.
It's payday loan.
So it's gotten that aggressive with the fintech.
It's payday loan.
I know, but the fintech, and this is very interesting to hear it from you, who works in that environment, that credit defaults by ordinary man, by one man on the street, is quite not as high as giving hundreds or dozens of billions to bigger businesses and all of that. Isn't that an interesting scenario?
It is, that's because, the total quantum that this, class of customer constitutes to the broad loan book of the bank is considerably low. So, I mean, if I'm giving out 100,000 or 1 million naira and, out of every 20, maybe just 1 or 0, defaults, because I've already checked their credit history. their transaction history with the bank with the help of NIBs and all of these other platforms, and I see they can pay. Apparently, they pay back. And don't forget what I mentioned earlier. The CBN has granted banks the opportunity to go to other banks to go, collect, their money back from other banks if a customer is defaulting. So all of these things is improving the general outlook of the credit market as we speak.
Very, very, very interesting. Very interesting scenario. I think that's a story for another day. So let's throw in a few monetary policy that you think will be on your playbook for the rest of the year. I'm sure MPC, the final MPC for the year will be there. But do you think the financial regulator, the central bank, has thrown in enough monetary policy action so far in the year that we're just trying to keep our nose above the water, as it were, on the market street, and perhaps you think the regulator should sit back a little bit and watch how things play out for the rest of the year? Or you think the environment internally and external vulnerabilities and risks and all that such that the central bank can't afford to go to sleep at this point in time?
Well, for the rest of the year and monetary policy, what we've seen is the central bank, using its periodic OMO to keep liquidity in check. Because I think, apart from FX, one of the biggest concerns for monetary policy at the moment is the size of liquidity that will be maturing into the system going into the last 3 months of the year. From what we checked this morning, total amount of maturity between now and December is topping 5 trillion. It's about 5 to 6 trillion if you take OMO as well as NT bills. And then, the CBN does not want that in the system because of the pressure on the currency. So we think monetary policy will remain, broadly tight. They will continue to use OMO to mop up liquidity as much as they can. The CBN has insisted that without inflation dropping below 10%, they are not seeing MPR coming lower. So we do not expect, any change in monetary policy. I think what they will be doing is basically just using market rates to, determine, where the market is. And I think generally, with the size of short-term uncertainty that we have both globally and locally, rates will remain broadly elevated. So monetary policy in Q4, we think we probably stay tight.
Stay tight. If you're looking at 5 to 6 trillion maturities into the market as a central bank, that's not the time to cut monetary policy rates, not in this environment anyway. Inflation will just hit you right between your eyes.
Correct.
And I'm sure that's what Gordon Emefiele meant when he says there will be no rate cut in 2019. Just forget it. How do you manage about 5 to 6 trillion maturity in the end of the year when there's so much spending already?
Correct.
It's going to be it's going to be a very, really wacky situation.
Rate cuts from the rest of the world.
No. It's not going to happen. So what's the playbook for you folks at United Capital? If you look at the various asset classes, where is your trading action going to focus on, or you think trading action or investors' interest should focus on for the final 3 months of the year, the final 90 days of 2019?
Well, for our clients that have been speaking with us, our advice to them has been, if you have, medium to long-term risk horizon, and you like risk a lot, you like equities, we have a host of stocks. Most of the tier 1 banks and a couple of tier 2 banks are actually pretty solid at the moment. We have buy rating on them, but those are not for speculative traders. Actually, some of them have done well for the year. Access Bank, for example, year to date is about 12% up. Others are not so great. On the average for the banks, about 13% lower. But we think, with the, spate of pronouncements coming out from the policymakers, things can change very quickly. So for those who have the risk appetite for medium to long term, we're advising them to stick to those high quality stocks. But generally, for short-term investors, our advice has been to stay with the debt market, especially short end of the curve. Yield on 364 days instruments is roughly 15 to 14%, 14.5% as we speak. So, those are still very, very attractive return for investors. And because of the level of short-term uncertainty in the system, this is where most people are also staying. So our advice has been for investors who don't have the risk appetite, stay in short-term bills for the next 180 to 270 days. Watch how the policy comes out and the effect. But if you are willing to take risk, the equities at the moment actually offer a lot of attraction for medium to long-term investors.
Thank you so much, Wale Olusi, Head of Research at United Capital. Do have a great day. We appreciate your time. We understand it's Monday morning. Tomorrow's a public holiday, quite a lot to do, and the final trading day of the month, a lot of meetings and all of that, and wrapping up the books as it were. Thank you so much. We appreciate your coming through on the show.